Understanding net debt, a comprehensive guide. Net debt serves as a critical metric in evaluating a company's liquidity and its ability to meet debt obligations when they come due. By understanding the intricacies of net debt, investors and analysts can gain key insights into a company's financial health and stability. What is net debt? Net debt is a liquidity metric used primarily to assess how effectively a company can pay off its debts if they were due immediately. It is calculated by taking the total debt of a company, both short-term and long-term, and then subtracting cash and cash equivalents that can readily be used to pay off these debts. Formula to calculate net debt. The formula for calculating net debt is as follows. \text net debt equals \text std plus \text ltd \text cce \. Where STD, short-term debt, includes debts that are due within 12 months, such as short-term bank loans, accounts payable, and lease payments. LTD, long-term debt, comprises debts with maturities longer than a year, which can include bonds, long-term loans, and capital leases. CCE, cash and cash equivalents, refers to liquid assets that can be swiftly converted into cash, typically including cash in bank accounts, certificates of deposit, and Treasury bills with a maturity of 90 days or less. To compute net debt. 1. Audit the balance sheet for all short-term and long-term debt amounts. 2. Add these totals to determine total debt. 3. Subtract the total cash and cash equivalents to arrive at the net debt figure. What net debt indicates? Net debt provides insights into a company's ability to service its financial obligations without facing liquidity issues. Overleveraged versus underleveraged. 1. Positive net debt indicates that a company has more debt than liquid assets, which may imply financial risk, especially if revenue streams diminish. 2. Negative net debt suggests that a company has sufficient cash and cash equivalents to pay off its debts and is generally viewed as financially stable. Comparisons within industries. While a negative net debt is often seen as advantageous, it's essential to consider the context. For capital-intensive industries, like oil and gas, having a positive net debt can be normal. Analysts typically compare net debt against industry peers to gauge competitiveness and financial risk. The relationship between net debt and total debt. While net debt measures liquidity, total debt captures the entirety of a company's debt obligations, both current and long-term. A comprehensive financial analysis involves looking at both these metrics to understand the overall debt footprint of the business. Total cash considerations. When calculating net debt, it's crucial to account for total cash accurately. This includes checking accounts, savings accounts, and liquid marketable securities. Some securities may not qualify as cash equivalents if they cannot be easily liquidated within 90 days. Conducting a comprehensive debt analysis. While net debt is vital, a detailed investigation of a company's debt structure is equally important. Considerations should include short-term versus long-term maturity. How much of the total debt must be paid within the next year? Assessing the maturity of debt obligations helps gauge financial health. Revenue streams. Can the company generate sufficient cash flow to cover all debts, especially in a downturn? Debt management strategy. A company that responsibly manages its debt may have access to additional financing options to support growth. Example, calculating net debt. To illustrate how net debt is computed, consider the example of Company A. Accounts payable, $100,000. Credit line, $50,000. Term loan, $200,000. Cash, $30,000. Cash equivalents, $20,000. Step 1, calculate total debt. Total debt equals accounts payable plus credit line plus term loan. Total debt equals $100,000 plus $50,000 plus $200,000 equals $350,000. Step 2, calculate total cash and cash equivalents. Total cash equals cash plus cash equivalents. Total cash equals $30,000 plus $20,000 equals $50,000. Step 3. Calculate net debt. Net debt equals total debt, total cash. Net debt equals $350,000 to $50,000 equals $300,000. Net debt versus debt-to-equity ratio. While net debt focuses on a company's liquidity, the debt-to-equity D/E ratio offers insights into how a company finances its capital structure. The D/E ratio compares total liabilities to shareholder equity and signifies reliance on debt. Limitations of net debt. Despite being a helpful liquidity metric, net debt has limitations. Companies with minimal debt may still face challenges in competitive environments, especially if they are not investing heavily for growth. Comparisons across industries. Since different industries have unique capital needs, it's not practical to directly compare net debt figures across industries. For instance, while high net debt may be standard in capital-intensive industries like oil and gas, it may reflect poor financial health for a tech company. Conclusion. Understanding net debt is essential for evaluating a company's financial stability. It reveals how much cash remains after satisfying all debts and illustrates the organization's liquidity position. However, investors should always consider net debt in the broader context of total debt, company growth strategies, and industry benchmarks to fully assess financial health. Utilizing comprehensive financial metrics provides a clearer picture and helps in making more informed investment decisions.